Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Airbnb stock because they recently reported earnings and the stock went up over 17% yesterday. And that's a huge move for Airbnb. So now this puts the stock up 47% on the year, which is phenomenal. But over the past 5 to 6 years, this company really has been an underperformer. And it really is just kind of been stuck in this $135 range because I've owned the stock several times. I've always been a fan of the company. I think it's a cool business model. I think there's a nice moat with this company, but the stock has just not performed well. So we're going to get into their earnings report as well as what's going on with the company and do I think this stock is a buy or not. So Airbnb jumps on an earnings and revenue beat as well as strong guidance for the upcoming quarter. They reported second quarter results, topping analyst estimates, better than expected forecasts. We see EPS of $1.37 for the quarter versus $1.25 expected. Revenue of 3.6 billion versus 3.5. Revenue was up 17%, which is very nice. That's a good number. And then net income increased to 800 million from 640 million, also a very nice increase there. They are expecting revenue for the upcoming quarter to be between 4.6 billion and 4.7 billion, while analysts were expecting the lower end of 4.6. So a slight increase there, which is really what investors and analysts want to see is an improvement for guidance. Then that would turn into about 14% revenue growth, which is still pretty solid for a company like this. It's interesting to note that for the Asia Pacific category, the growth was in the high teens, while the Latin America business saw bookings growth of about 20%. So it's interesting to see what areas are growing faster than others and where are the opportunities at for this company. The company highlighted particular strength in Brazil and Mexico. So that's very interesting that that is where the growth is. Free cash flow jumped 30% to 1.25 billion. 30% is huge. That's a really nice increase. And that's pretty much it. And the reason, one of the reasons I use Airbnb almost at least once a year, I would say. And one of the reasons I really like this company is because I feel like even though there's other companies like Verbo and of course hotels are still a form of competition for them, but Airbnb is a moat or it's unique because let's say there's millions of different places you could stay on Airbnb, right? And once those places are on Airbnb, then that's it. That's kind of like it's you could put an Airbnb in a lot of different places that you can't put a hotel and just things like that. It allows for you to stay at really unique places. And so I think that's a really strong moat for this company. So the two-sided network for this are the hosts and the guests. The kind of the profit margin for them on this whole process is 13 to 14%, at least according to Gemini it is. And they have over 8 million active listings, which is crazy. And like I said, a hotel can't always replicate that. And sure, some people might use Verbo or something, but as far as I'm concerned, Airbnb is number one. That's kind of the name brand in this market. That's always the company I go to. I always search on Airbnb if I'm looking to stay someplace. That's kind of just a go-to for a lot of people. So Airbnb collects fees from both sides of the transaction. A guest fee is about 14% or less, and a host fee is typically 3%. Unlike traditional hotel chains, they own zero real estate, which means very low capex. Very nice. Now, does this company have a moat? Well, let's see here. They possess a two-sided network effect moat and a brand as a noun moat, which is kind of what I was saying. Like that's kind of the name brand. When you're going to stay someplace, a lot of people go straight to saying, okay, I'm gonna pick an Airbnb. So over 90% of Airbnb's traffic comes directly or organically, not through paid search engine marketing, because most people already are familiar with the name. This provides significant customer acquisition cost advantages over Booking.com or Expedia, which spends billions annually on search ads, which makes total sense because I pretty much I don't ever type in Booking.com or maybe once or twice I've typed in Expedia, but really Airbnb is where I'm going to search to look at all the different properties and all the different options. More hosts attract more travelers, and a larger pool of travelers incentivizes more hosts to list properties. Just like the same thing with Uber and DoorDash and all these other companies where, you know, each side feeds each other as they grow. This feedback loop makes it difficult for new entrants to gain traction. Over 85% of listings are individual and independent hosts offering unique spaces that cannot be cross-booked on traditional hotel platforms. Like I was saying, really nice moat here. It's a really a disappointment that this stock has not performed well over the last 5 years. Because I remember I bought this and I kind of would just hold it and it wouldn't go anywhere. And when you look at the financials, revenue has done absolutely fine, but it's just been a profitability issue. Net income was flat, and same thing with free cash flow. It was flat too. So what are the growth drivers for this company? Number one, long-term stays, remote work, and flexible living have expanded the addressable market. Long-term stays represent 17 to 20%, and first-time in Gen Z booker acceleration, first-time booker growth accelerated 11%, heavily driven by younger Gen Z travelers adopting alternative lodging over standard hotels. Under-penetrated markets include in Latin America, Asia Pacific, non-urban Europe represent significant runway for host and guest acquisition. Then new businesses and experiences, relaunching AI-powered guest experiences, host services, etc. Then we have, okay, revenue was up 16, 17%. So this was, I mean, this was a year where their numbers, where net income, where free cash flow definitely jumped, and the net income was also increasing at a nice clip too. So Gemini has the bull case at $200, a bear case at 120. That's about right. I would say a base case of more like 140, and then a bull case, yeah, a bull case of probably around $200. I mean, I don't think the stock trades super cheap or anything. Um, what are we're looking at a PEG of 1.6, forward PE of 34. It doesn't trade super cheap. So I mean, it just depends if they're growing net income or not. If they're growing net income and EPS, then it makes a big difference. So the growth is not huge, but I mean, this company is already so massive. It's like, how much bigger could they really get? But we are looking at GAAP EPS of $4 last year, 5.2 this year, then 6 next year. Which again, it's not insane growth, but it's good, it's steady, and it's what you would expect for a company like this. So I would say I don't know. I don't know if I could see the stock going too much higher than this price because I mean 30 times 6 is 180. That's already off of next year's earnings. You're already paying 30 times next year's earnings. That's about right in line with what I would expect for this company. So I don't know if I would see it jumping up too much higher than that. Their cash to debt ratio is great. They've been buying back shares for over 4% a year. That's really nice. And then ROI of 29%. That's actually come down a bit, but 29% is still outstanding. Profit margin of 22%. That's also outstanding. So I definitely would not buy it here. It's just this is a tough one. I think this stock just since 2021, I think this stock just got ahead of itself in terms of valuation, and that's why it hasn't performed that well. They're if the stock's trading at 40 times earnings and they're only growing whatever 12 or 15% per year, net income has it been flat. I mean, it's really because of net income. Net income dropped off huge from 2024, and then these last 2 years have been kind of flat. That's really what's keeping the stock down. I mean, if this jumps up to $4 billion or something, well, then we're in a different situation. But that's the way I see it. I definitely would not buy it at this price. I mean, if you were buying it in like 130 range, that would have made sense, I guess. But at this price, I would not be buying it. And that's coming from someone who is, I like I said, I'm a total supporter of this company. I love the business model, but it just wouldn't make sense at those for what they've done in the last couple of years, the growth rates they're expected to do, and the valuation that it's sitting at right now. It just wouldn't make sense because you're already pretty much pricing in next year's numbers, and so I really don't see it going to $200 plus. But that is my analysis for Airbnb. Let me know what you guys think down below, and I will see you in the next video.